Welcome to today's edition of Commodities Corner, the programme specifically designed to give you a better insight into commodity markets. Today's guest is Mark Pervan. He's Head of Commodities Research at Australia and New Zealand Banking Group, also known as ANZ, and he joins me now on the phone. Mark, thank you very much for joining me. Now, first and foremost, what are your general views on the state of the global commodity markets at the moment?
Look, I think there's a general propensity for funds to move back into the market. I think they are looking for, I suppose, a bottoming out in the China cycle and looking to probably find these as good entry points. But at that stage, I think there's still enough uncertainty for them not to be buying too heavily at this stage.
What about Chinese economic growth and steel demand? Iron ore prices have rebounded recently, but is this upward momentum in demand sustainable given the deceleration and uncertainty in China's economic growth and further stimulus?
Well, I think the longer term outlook's still in place. There's still a heck of a lot of infrastructure construction to be done in China, but I think the near term China may have overstimulated itself, and also I think there is some structural inefficiencies around some of the heavy industries, particularly in steel, where they may be producing more than they currently require.
What about another large commodity market by value, crude oil? Besides tension brewing in the Middle East, in your opinion, what are the other most important driving factors which will be influencing movement, and where do you see prices heading?
Well, I think the oil market's being the most liquid and the highest traded market in commodities is heavily influenced by investment fund flows. So there will be quite a strong link between oil prices and the overall performance, say, in equity markets where investors are obviously very active. So the health of the US stock market particularly will have pretty strong bearing on oil prices in the short term.
Looking at gold, for example, or even silver, do you think further gains for gold will require a new catalyst? And if so, what are we talking about here? Is it renewed escalation of the Eurozone debt crisis, the US's fiscal position? What is looking like the next most likely trigger for precious metals?
Well, I think one trigger that's seen gold move into a higher trading range has been the recent announcement of further quantitative easing in the US. I think that's now priced in. So you're right, looking for the next catalyst. I think the next catalyst is going to come out of Europe, and it's going to require, I think, more stability in Europe, because the instability in Europe's actually been a drag on gold prices. So we see, if they see some resolution around maybe Spain, that could be the next trigger for further buying in gold. We've still got a fairly conservative view on gold prices because it tends to notoriously move against your view, or at least it can be quite volatile. We've got a year-end price around 1780, but we see it moving up to sort of the high 1800 level, 1880 by the end of next year. So potentially testing historical highs in the second half of next year, which was around 1900. What
about other base and industrial metals?
Yeah, the industrial, particularly the base metals, very heavily leveraged to China. The China market now consuming around 40% of the global base metal market, so very important market. So we'll be looking for the overall growth numbers in China to start to well, the direction, I suppose, will have a big bearing on prices, but we think GDP should start to improve slightly over the next 3 to 6 months, and that could see firmer base metal prices as a result.
Mark, thank you very much again for joining me and sharing your views on some of the commodity markets. Now, the next edition of Commodities Corner will be coming your way on Thursday. But in the meantime, stay tuned to DukascopyTV for more financial news, updates and exclusive interviews. Goodbye for now.